got Ed Horn-Smith, Managing Director of Ark & Co. Ark & Co is a specialist debt advisor accustomed to complex transactions. And then we've got Nicholas Giotto, Chief Investment Officer at Spice Capital, one of the pioneering family offices in real estate lending. And then we have Sebastian Decker, Director of Savills, a true industry veteran. Well, our next speaker apparently likes long walks by himself, poetry and clearly getting stitched up by his colleagues. Daniel Ben David, Managing Director of Flourish, and our host for today's fabulous event. Thanks for coming. What a great turnout. This is a really interesting week, actually, to have this type of panel discussion with the summit over the next couple of days. And hopefully an agreement will be signed during those, and then on Saturday, hopefully something will happen at that point. Who knows? We've been actually discussing over the last couple of hours what our thoughts are on this, and I haven't actually looked at my phone to see what's been happening, if anything's happening, if Boris Johnson's still around, who knows. So today we're going to be looking more about actually what the real estate market will look like after Brexit, and while we don't know what that will look like and when that will be, I think we all kind of have a perspective on how that could potentially change and where the opportunity lies. So I think this would be a great topic to talk about, and also what other drivers are affecting this. It's not all about Brexit, thankfully. So to kick off, Daniel, in a post-Brexit environment, what geographic areas do you think are likely to gain, sustain, and possibly fall?
Well, what we believe is that there are different segments of real estate, so it's not only geographical areas that you have to look at. It's geographical area with coupled with type of asset. Depending on the Brexit, if it's a hard Brexit or deal Brexit, we see prime central London as being one of the pockets which would recover value after a short period of time. Basically, I was very worried for the first 6 months of the year, knowing that there was no liquidity at all, and nothing, no potential buyers on the market. And since summer, situation has kind of changed. People are, I guess the opinion now is like there is a kind of a trough in the market, and that it's a good time for foreign buyers to come back on the market. Doesn't mean that there cannot be a potential fall, but it's going to be limited unless we are looking at a global kind of recession. And I think in the case of a Brexit deal, you have a small increase in the value of the properties. Mm-hmm. So people are now, looking at investment opportunities. There's not for the prime central London, the good stuff. There's not so many assets on the market, and there's a number of reasons why the stock is not that massive, because some of the property, the rental market is still strong, and some of the property that switch from selling to rentals. Mm-hmm. So the effective stock empty available of prime quality is not that great. So basically the people don't have a lot of stock to decide, and they're back. We see number of offers. Offers are not done deals, but it's been a strong improvement in the last months, and it's picking up. So, from a gloomy situation a few months ago, we can see better times. Waiting for the cherry on the cake, maybe it might be a deal for the Brexit, which we will know fairly soon now. In terms of other geographical areas, so we believe that depending on the type of asset, north is gonna continue to develop. Mm. Of course, different new form of asset like operating business, such as senior living or student housing, is still going to continue. And if you go out London, you're more based on the domestic kind of market, where you have a structural lack of housing. You know, the number of housing that we need to provide to meet demand overall in the UK is massive.
Sure.
So you know, you need to go down to looking at the proper numbers and forget the panic that you can read in the press for the last 2 years, and try to analyze the proper numbers and see where you are in the market and the cycle.
Sebastian, you were mentioning earlier about the regions which have opportunities and also the asset classes.
Yes, we were talking about that, and basically outside London, it's not all about London, but it's much more dependent on if you're going to the north, as Daniel said, or Midlands, then you are more dependent on perhaps manufacturing or farming, where it might be more dependent on the Brexit deal. And all those communities are also probably more focused on one or two employers, as we've seen in the past. They've historically, if one leaves, then the whole community gets assembled and the property prices fall and people can't get the jobs. But I agree with Daniel. We're certainly seeing a bit more investment in central London and overseas buyers, and particularly with the rental market, people are now deciding to rent rather than buy, particularly in light of the stamp duty. And some of the big players are now in London focusing on residential-led schemes. So Grosvenor, a native land, have just started a 1 billion regeneration of South Bank. Other players have been redoubling their efforts on residential-led schemes. Invesco, for example, was going to double to £4 billion on residential-led developments. So yeah, it's not all doom and gloom. I think certainly from a valuation perspective, we're seeing there are big deals being done. Certainly, there's perhaps a return to best bids in some cases. So on certain classes, it's not certainly across the board, but it's not all doom and gloom.
Ed, what else could affect certain geographical locations across the UK?
Yeah, I mean, obviously, following on from what the guys have said, I think it's very much going to depend on where we've come from, not only where we're going. So, I think the optimism in the London market that Daniel and Sebastian are talking about, we have to look at in the last 4 years has been a downward market in London. Okay, where prices have fallen between 15 and 20%. Not just because of Brexit, because of stamp duty, and because probably we're at that stage in the cycle. I think when we look at other areas in the country, that's not necessarily the case. I think we've seen, some quite sharp growth in some of the kind of major cities outside of London. So we've seen a huge amount of building in the likes of Birmingham, Manchester. So while London's slowed down over that 4-year period, those areas have continued to grow and grow at a real fast pace. So I don't necessarily think what we're going to see outside of London will be the same as what we see in London. I feel they might be a little behind the curve.
Do you think in that case, is there a worry that the northern regions, for example, that have had a big spurt of growth, will they also see a similar correction of pricing like London did?
I mean, it's hard to say. I can only talk about from my experience in arranging debt for developers and investors. But I mean, we've been where there's been a huge exit out of London from major lenders. They've been incredibly bullish in the more regional areas. So where we've been arranging debt at 60% loan to cost in London, we've been arranging debt at 90% plus outside of London. And I think there's going to be a knock-on effect of that. What that knock-on effect is, I don't know.
Nicholas, what opportunities do you see geographically in the UK?
And first of all, if you look back on what happened, 3-4 years ago, everything was priced the same way. Everybody would look at price per square foot, whether it's a basement or a duplex on the last floor. I mean, today everybody's more reasonable about analyzing the asset itself and not just saying, I'm in an area, I'm almost prime, I'm next to the super prime, so I should be priced at the same way. This is a big difference. And I think us as a lender, we look at that on each project. Obviously, we lend to, and we see there's a huge discrepancy in the same area. We just recently looked at some project close to Fulham, and one project didn't make sense, and the other one just because a couple of blocks away. The market has brought this, and I think it's good. You can go back on a sound basis. Now, regionally, I think there's definitely some opportunities. Not an expert in the UK regions, but you do find, especially when you look at the yields, and it all comes back to the yield of the asset itself. You know, why would you invest at 2%? Well, at 7, 8, 9, then you're going to start thinking about it. Other people will start thinking about it. You're going to be able to put some debt behind that at a reasonable price, so it all makes sense. When you see that type of asset coming again, then it means that you're probably somewhere close to the bottom, and then there's the momentum. Talking earlier about that, I think a large part of the investors look at momentum, especially a Chinese investor, for example. So we were saying, well, the currency has come down, why don't they come in? Well, I think many of those investors like when currency is going up, when market is going up, that's when they come in. It's not the other way around. So you need to see that pickup, that momentum going back. And we are seeing some signs of it. We obviously need a couple of months and hopefully a deal to get confirmation of that.
And are you seeing yields change in central London? Because we were talking earlier how more people are, instead of buying and selling, they're renting them out, so yields are going up potentially. Is this something that you agree with?
They're still quite stable. Certainly, prime central London probably between 2-3%, depending on the asset. Flats probably slightly higher, but on the rents that we're talking, people are sort of accidental landlords. You're looking at sort of 2.5-3% for prime stock.
Okay. And what asset classes are you seeing trends? Because you mentioned earlier senior living, student accommodation,
yes.
Essentially. What's flourishing? What will flourish in a post-Brexit Britain?
Well, I think there's certainly been a lot of talk about senior living. Looking at statistics, I think there's going to be 4.4 million over 85s in about 30 years. So I think it's a very mature market. It seems to be mature. The US has got quite a march on us, but I think it's certainly something that people are looking at. So it will be a very similar product to the student living, where you're having apartments around a courtyard, around a communal facilities, and any development that we might do. There are some aspects of it where there are age restrictions. You're certainly seeing some of them coming in now, retirement living, so you have to be of a certain age to buy there. But certainly from a downsizing point of view, people are downsizing from perhaps bigger houses to these self-contained apartments or houses, complexes, which offer some medical facility. They might not. It might just be a porter or something.
Are you seeing any new asset classes, or are you diversifying what you would typically lend on?
Well, we apart from co-living and I wouldn't say co-working, because it's not the flavor of the time, but co-living and senior living are the main new kind of asset classes. The rest is kind of the same that we've seen. There's still a strong business in the hotel segment. Restructuring, like the 3-star hotels into a better managed type of asset.
Mm-hmm.
We see that a lot.
Branded residences.
Yeah, branded residences. Going like what the Peninsula is doing. So these are the main new asset classes.
Why do you think branded residences are becoming more popular?
People like service, People like service, and the way to convince them that they're gonna get service is to have a known common standard. So it's like Four-Seasons hotel. You go anywhere in the world, you know what a Four-Seasons is. And so if you sell a branded apartment, and you know what you're gonna get.
Mm. Edward, how do you expect overseas investment to change in a post-Brexit Britain?
I think it's funny you should say. I was at an event. Had an event which was based on overseas investment, and most people in the room who were investors didn't have a huge amount of concern around Brexit. Most of their concern was around the next government, right? I think there's been Brexit uncertainty for over 3 years now, right? And I think in a lot of ways that we've seen certainly in London that's affected the market and affected the property market. But I think one thing that was clear from them all, the liquidity is still there within the market and they still have capital to deploy. So I don't necessarily think there's been as big a kind of nervousness as you might read about. But I do think whatever decision there is, the investment will be more based on how stable the government is as opposed to the outcome of Brexit.
Are you seeing overseas investors interested in certain asset types or locations?
Yes, it tends to be probably more again. Central London is what I'm involved with, but yes, it tends to be prime areas, Mayfair and Belgravia, Knightsbridge. There's been a lot in the press about people buying in now and buying houses, investment or for rent, seeing it perhaps at the bottom end of the market, seeing now as perhaps as a turning point. I think with any investment, you have to buy the best you can buy, or the best in class. So whatever level you've got, I think you have to buy the best level. So near transport, or perhaps a new development with porters, gym, swimming pools, etc.
Sure.
So I think we'll certainly see more foreign investment.
Okay. Can you plan ahead as a lender for multiple scenarios, and do you?
Yeah, we do. Basically, what you try to do is design your lending to sustain any kind of form of scenario. So basically, depending on the asset class and the type of lending, you can try to define according to the different scenario what might happen. So basically, if you're talking about prime central London, you want to finance something that's gonna sustain the worst case scenario, that you're gonna have demand from the investor that might stay in the worst case situation, or that an asset that you will be able to hold and rent and still get your money out. So obviously we've been much more conservative on the lending for the last few months, and will continue to be as long as we don't know which scenario would be the reality. But we lend on adjusted values, as Ed was saying. It's like 15-20% drop since before the stamp duty, let's say. Everyone, we were lending at 60-65% at that time, okay, which seemed to be as a cautious policy. But if you look at pre-Brexit or seasoned loans from that time, you're quite high now.
Yep.
Because of the absence of liquidity, it's not so much the market, it's the fact that you couldn't sell the asset. So basically you squeeze between an asset price which has gone down 15% and a debt which is accruing because you can sell. So still, if you lend at 60-65, you're still in the money. Okay, so if you're able to sustain that kind of scenario and not use your money on the debt, it kind of show that you've not done things completely wrong. In order to be even more conservative, we do kind of a 60% lending to adjusted value now. And what we would do, we are lower if assets are more chunky, and we try to finance deals where we know that most of the units, if we are financing units, will fit to help to buy scheme, which is the kind of only scheme that works perfectly right now, or in areas where we know that given our debt level, we would never have any problem should we have to repossess the asset.
Sure.
Obviously, we're basing our lending now on the worst case scenario. I would just comment on the worst case. There are scenarios where you cannot prepare. So basically, I'll be honest, if we have a new election and obviously Labour in place, which has already announced that they will have very difficult measures for real estate, that would be kind of an unknown territory.
Sure.
Doesn't look likely now. Even in these, the level at which we lend will make sense for us to hold for the asset for a few years. Our yield would be like 5-6%, so we'd be in a scenario where we can hold the asset for some time and just go back to the market when it's better.
Sure.
So
I mean, you're already lending quite cautiously as it is, but does everyone think that Brexit has already been priced into current values in the property market?
Yes, I think you can never price for it because everything's relative to the market. But you're already seeing, certainly unlike stamp duty, which is a sort of known fact. I think certainly the market's taken into account already. And anyway, the valuations look back. In some ways, our valuations look back. So we're trying to sort of see, but obviously taking into account sentiment. But what Daniel was saying about the holding, I think that's what we're seeing the rentals. So people are renting. So people are we're doing valuations where new development, new house, they then rent it for 3 years. So everyone's sort of covered. So they're covering, they're servicing their debt. Other people renting it in a good position because they've saved the stamp duty, and so everyone's sort of winner in some ways. Those, and then as Daniel says, you've got to hold it for 3 years and see what happens.
I'd just like to point out that as a lender, our goal is not to repossess. Okay, because Daniel was saying it's really a critical scenario. Yeah, it's really a worst case. But when we analyze, we always try to understand the exit strategy of the borrower. I mean, that's crucial. And if the project makes sense, and also the equity involvement of the borrower, in certain ways that, if he has a lot of equity in it, it's less likely that he will back out of the deal. So that's really important for us. So doing your analysis, I mean, even if the LTV is low, sometimes it doesn't make sense, compared to other projects. So you have to be very careful on day one, knowing what's the exit strategy. And if you see in the life of the loan, if you see a change in this strategy for whatever reason, that's when you should be getting nervous. So, but again, repossession is, although it's a protection.
Well, it's really communicating with them quite early on, just making sure that they're on track. And I assume that's where the role of a broker comes in at this kind of time. How important is it for you to be involved and for other brokers to be advising clients when we are going through periods like this?
Yeah, I don't think it's just at the moment, but I definitely think an advisor has more importance in difficult times than the easy times. I think what we've got in our market at the moment is a huge amount of liquidity and a huge amount of new lenders, untested lenders, and you don't necessarily know where their capital's coming from. I think in this market, it's very important that you can draw upon the experience of people that have worked with lenders previously, their processes, where the actual principal capital comes from. I think that's very important. And to add to that, it's also important to understand what happens if the loan doesn't go the way that it was meant to go. So what happened? How will the lender act in a default situation? And there's very, very different ways different lenders react, and it's important you're partnering your client with a lender that acts appropriately.
Currently, I've heard from a couple of brokers and lenders actually that there have been some Brexit clauses in valuations recently saying, if it gets to, this is valid up until the 30th of October. First of all, what impact is that having on the market right now? And also, if we do have to delay Brexit again, what impact will that have going forward? Will we see more of these clauses, and why are they put in?
Well, I'd be very, I'd be very surprised to read if there was a clause saying it's valid till 30th of October. And if it is, it shouldn't be. Because you're not looking forward. You're looking back. But I'd be very surprised.
Sorry, 30th.
Yeah. 30th. But I'd be very surprised if there were clauses there. The RICS have a normal uncertainty clause. The fact that we started putting out evaluations in 2007, 2008, which just means that you're going to be a bit more cautious. There's a bit of uncertainty in the market, but we haven't had any sort of blanket instructions on that yet. So we're just taking just the normal valuations. With regards what was I going to say? The sort of reports. I think we just have to try and be realistic on it. I think there's no. I don't think you can factor it in, because I don't think there's anything you can say that will or won't happen.
And can tech and data help in this scenario?
Yeah, it does. Basically, we value a lot the work of the experts, but we have to get our own opinion of the valuation. So basically, we're not gonna just accept numbers. So in a way to check that what we're gonna get is what we think. We need to form an opinion, and the only way to form an opinion is to collect enough data on the market, the past, and the comparables, and a number of other variables that we would fit in our analysis. So yes, of course, collecting data and analyzing is very important for us, coupled with experience of what happened and type of asset or type of problems or reaction from buyers to kind of situation. So basically, we know that short leases don't appeal to a lot of buyers. They don't understand, they don't like. So knowing that, you can adjust, to the asset and understand valuation better. But that's key in the process. It's just not accepting the valuation as just as a given number. Going there with an opinion, and fine if the valuation gives the same result, it's fine. If it doesn't, test the valuation and try to understand why you should accept it.
And have you seen any of these Brexit clauses in valuations?
I haven't in valuations, but I have seen them. I have seen them actually in finance office. So specifically, and I won't name the lender, but specifically a land loan being made available immediately, and a development loan approved subject to the outcome of October 31st or 30th. So, and in that instance, as an advisor, we went somewhere else.
Sure.
Okay, because
is it worth the risk?
Well, any decision isn't going to be ultimate, is it? One thing we've learnt about Brexit is it just drags on forever, right? Yeah. We might get some form of certainty, but likelihood is, they're going to kick the can further down the road, and it just doesn't. Clients need certainty, and clauses such as that just don't give that.
Does anyone think that if we do leave without a deal, that this uncertainty will just be lifted? Because in my opinion, there's going to be even more uncertainty because no one knows what that could include.
I think it will depend on who is there if there is no deal. Okay, it's all a relativity of London or the UK compared to everywhere else. So basically, it's what you do to attract people. So basically, for real estate, you have a key number of assumptions. Besides macroeconomic numbers, you have tax, infrastructure like school services. You have security and stamp duties. If you do something on these, you'll attract people. You know, it was the case before. You know, when you look at London in 2008, you know, London was seen as a safe haven because of liquidity, but because of all of these factors. You know, lifestyle, schools, infrastructure, and all the rest. So not so much has changed. It's just you know, uncertainty of the political environment and the tax environment is the main causes of the downturn in the London and UK real estate. Is that there's nothing else. So bring back a bit of stability, visibility for investors that they can stay and they're not going to face, you know, massive increase in tax. And so it's clear, you know, no deal Brexit depends who you have in as a prime minister, you know. So one side we know that there's a strong tendency to lower the stamp duties and do some tax measure. On the other side, it's the opposite. So you can see where the market can go either way, you know. So it's not so much dependent on no deal or deal, I guess. It's more next step. If you have a no deal, it's more the next step.
Okay.
Because you've got the, I suppose you've got the threat, as you said, the threat of the Labour government and taxes and
That's more overarching.
public schools, which obviously is an attractive for high net worth coming to the UK. All these factors, and the city, you know, it's all. There's not been easy.
Sure. We were discussing earlier as well about the commercial property market not having a huge amount of innovation at the moment. Daniel, do you see this changing in a post-Brexit environment? You both go.
No, commercial is it comes down to, I think, some of the discussion we've seen recently around the WeWork story is a good example. And we've seen some deal, I think a large deal in next to Waterloo, I think, didn't go through. It all comes down to the tenant, the cash flows, how long they're going to be there to pay. And for large deals, you get into, I think, international comparison. You know, on smaller deals, again, you want to analyze the quality of your tenant, the cash flow, and that's where the bank is going to come into finance you. So, obviously, we all know that retail might be a challenging area for reasons we all know with Amazon and all. It doesn't mean that it doesn't make sense. At some point, retail makes sense if the rent is correct, if the shops can make money. So, and we have seen some interesting proposition, not in London, outside of London, where what I was saying earlier, where you get interesting yields, and you know it doesn't mean it's not risky, but you're getting back to a level that makes sense.
Is that on a retail side?
Yeah, retail. Yeah. Now, on the commercial itself, I think if you're owning a large tower in Canary Wharf, lending to a large European bank that's going to move maybe half of its staff back to Frankfurt, wouldn't be that comfortable. If you have something in Mayfair with small companies, financial, you know, family offices renting your place, I think you're much more comfortable. So I think it all depends. It's very local. It all depends on who's your tenant more than necessarily the area. I mean,
Sure. Sebastian, do you think the commercial property values are overpriced, underpriced? What do you think going forward as well?
I'm not too much of a smash specialist, but we were talking about the retail and certainly undersupply of offices.
Yeah.
And just looking at the high street, just seeing what can happen there, what can be done to regenerate it. Certainly out of central London, out of London. Just the type of shops, rents being reduced, and just being more practical.
Do you think that could solve the retail problem with rents being reduced, or do you think it needs to be more than that?
Well, I think we agreed that it wasn't the fact they didn't sell anything; they just weren't making enough money to pay the rent. You know, that's why shops are closing. And it's a shame actually, because you've got, let's say, Pizza Express, but it expands quite quickly, and a lot of them on the high streets are sort of, you know, in the home counties and so on, which then don't get the footfall, you know. So it all goes through, and then sort of just they become empty, and then they pop up shops, and it's all like, you know, it's a cycle. But I think we're discussing how to make it more affordable would probably generate it.
And Ed, you were mentioning earlier that there's some opportunities out there for commercial, for people to buy, or...
So I've got clients at the moment that are specifically targeting retail in the best high streets in the UK, just because, you know, there's a lot of availability. You've got big funds like Threadneedle selling off portfolios, and within that portfolio, 90% of it might be overlet and, you know, dog properties that need reworking, but that 10% you're likely to be buying massively undervalue. So if you can take that portfolio, trade out certain properties, and you've got a business plan for the remaining properties, you know, you're buying them, I think, at almost nothing.
What about the semi-commercial market? Could there be, is that a safer place to invest in? Are you seeing any trends in that area?
I think from a personal point of view, and again, I only know about the financing for developers and commercial investors, really. But actually, shops and uppers I've seen less impacted by what's happened in the retail market overall. So, you know, people still want to buy a pint of milk and loaf of bread. I haven't seen that as impacted, and as well as that, because they're commercial, you've got the residential to lean on if you know there is a vacancy. So I would, subject to the location and everything else, I would say it's a less affected area. And
Daniel, do you think lending terms will change after Brexit?
Yes, depending on, I cannot tell you which way. It all depends on which kind of Brexit and which kind of environment. You know, hard Brexit, definitely I see banks, you know, not being, you know, more, you know, willing to lend money for real estate. So obviously there'll be a tightening in lending conditions. You know, the gap is always filled by people like willing to take the risk, but yes, I think there will be a change, and if it's a Brexit deal, then I see liquidity is gonna, which is there, is gonna again go for various projects. It's gonna be our job not to do the project we don't believe in, you know. But you know, the beauty of lending is that there's always something to do, market going up or going down. So just pick up the right opportunities.
Sure.
It's interesting because on the actual cycle, looking back at 2007, 2008, there were lenders in up to that who were lending 75, 80% loan to value, perhaps more, just to get, because there were people so much appetite for buying. And lenders we dealt with over that period who were still lending 55, not being aggressive, not being there, were sort of just rode the storm. Yep. We're out the other side and sort of and still performing. And I think you look back at that and people say, I wish we'd have, you know, being at the bottom, I wish we'd have bought then, but in fact no one would lend the money then. Yeah. So are we going to say this now in 3 years' time or whatever, 4 years' time, that in fact this is the bottom, you know, why weren't people lending on the, you know, 1st of November? Yeah. When you knew it was the bottom, you know, when now it's 5 years later, because we saw it goes in cycles, and I think you can even, I know it's not, you can't always look at historical data, but after all the various things, stamp duty, it drops, and then it rides, you know, 6 months, 9 months, it goes back up, or a year, but it's not sort of a long, it's not long term. It'll always ride through, but that's interesting. So when people were lending, people then stopped lending, the people who were lending 85, because everyone was, you know, the market dropped, but the people who were lending 55% just carried on, just doing that, so, but people couldn't buy.
Exactly, and with the bridging market at the moment, it's extremely competitive. Got a huge number of lenders, and we were discussing this earlier. You know, can't really keep up with the numbers out there, and is there a worry that some are lending quite aggressively leverage-wise because there is probably not enough business to go around in that space? What's your thoughts on that? And do you think there needs to be a bit more caution in that market?
If you ask me, yes, I think so. But after that, different people, different lending policy, and Ed was saying something very true. You have a lot of people lending the money of others. Okay, so it's easier to do a loan when it's not your money, when you're only interested in the upside. Okay, so obviously, I think that there's a lot of leverage and very aggressive lending on the market. Yeah,
We'll see a lot more peer-to-peer lending as well.
Yeah. Because if you check, there's a lot of lenders, but if you check the actual backgrounds of the people, I'd be interested to see how many have done investment in property or property lending as a background for long.
Right.
So that's another point. Who have been in front of an actual problem? How many of them have done repossession or faced another cycle in real estate, not in another industry? And you'll see that the number of lending you'll get is going to be substantially low.
Absolutely.
Proportion is going to be very low.
Well, there are lots of new lenders in the market, but if they've got experience and they've worked at other lenders for a long period of time, you've got those connections there, then that makes sense. Yeah. But I think, Ed, you mentioned earlier about principal funding. Is that really where you'd only look at, whether they're your kind of first go-to lenders?
Yeah, I mean, it's not the only thing we can look at, because that would discount nearly the whole market. But
they're your preference.
In a tough market, we'll try and stick with principal lenders, or as close to principal lenders as we can, because the insurers, AIG, Mass Mutual, that lend to most of the market aren't really in the market at the moment, and the message of them not being in the market often takes a long time to trickle down to the people lending their money. So we've almost gone back to fundamentals on bridging now, where we want certainty, we want speed, and the client doesn't mind spending a little bit more money to remove that transactional risk.
That's why as a family office we're never the cheapest or lending the highest, but we do get the deals because people know that the money's got to be there.
Yeah. With loan terms in the market at the moment, for a bridging loan, let's say, do you think that because it is an uncertain market and we don't know what's going to happen in the next 6 months, 12 months, 18 months, do you think loan terms are shorter than they should be or longer than they should be? Like, what do you think the state of that is at the moment? Because we're seeing a lot of extensions and a lot of refinance, rebridging.
That's the game of the market. No one wants default. So 2008, if you looked at banks, they had 90% default, but no one had default. They had extensions. So it's always the case. You kind of want to deal with the problem, give more time. That's normal. But extending, I don't think the maturity of the terms are the real problem, unless you want to go to 5 years and it's no more a bridge loan. Yeah. I don't think it's going to change because you have 6 or 12 months. The problem is in the next 3 months or 6 months. So basically, unless you do a 1 month lending, you're going to have the issue anyway. So I guess it's what Nicolas was saying about exit. It's to define and lend on schemes where you can see the rationale of the scheme, whether there is no Brexit or there is a hard Brexit, because at the end of the day, there's still going to be people in the UK, I guess. They still want to buy properties, and if it's at a reasonable level, they'll buy it. And so you want to lend on these, not on like funny things in the middle of nowhere where you have to create them. So I don't think the terms or the maturity the bridge loan market or the refurbishment is the real issue. Is like
It's what happens at the end of those. Yeah.
And the domestic market's much more medium to long term anyway. So it's 10, 15 years rather than 3 to 5.
Sure. And there are, just going back to how competitive the bridging market is, there are a lot of family offices supporting, backing this market and more coming in. What do you expect this to increase going forward or decrease when we find out what's happening with Brexit?
I think in general people, and that's everywhere, people are interested in, I mean, yields are so low everywhere. Private lending is interesting for everybody. Now, having said that, it doesn't mean that they necessarily know how to do it. And that expertise is very valuable. People like bridge and even the structuring behind, that's part that is very important. Many are willing to lend. It's just like, okay, what do we do? It's not, and just defining your price it's not enough. There's a lot of analysis that needs to be done. So we have some co-investors in some of the deals, and it's always the same. They're interested, and then how do we structure it? So I think obviously large family offices have this capacity to hire teams and deploy their own capital. Then so if they're UK based, they're comfortable with the market, but then some foreign family offices don't necessarily want to invest in this market in the UK if they don't understand it. So it's complicated. And then UK is also interesting because we were talking about repossession earlier, but repossession is easy here. If you compare it to the French market, but you're laughing. The French market, we're talking years for repossession. So it's a completely different market, and the pricing there is definitely more aggressive. So I mean, all those parameters go into place. Definitely more people are looking at it, but I'm not sure they all know how to do it. So hopefully we'll still have some margins there.
Ed, do you think there's enough business to go around for new family offices coming in and new lenders? Do you have any worries about that?
Yeah, I not at all. I think there's always business. The type of business changes, but if you look, nearly every property's got existing debt on it, and everything's got a term. So it's like a ticking clock, right? So it's always going to need financing. It's just a matter of time and what type of financing it will be and what leverage it will be. But there's never any shortage of financing required. I think in terms of family office finance, I think it's definitely a growing business, and we're seeing it becoming more sophisticated, and there being not a massively wider pool available, but the pool's widening slightly. But it will go back down to fundamentals again, building a track record and having people managing those offices that know what they're doing, and also having actual families behind the office, because there's a lot of family offices in Mayfair with no families. I think we've all met them. Yeah.
Do you think institutional funding, and bank financing, will withdraw or increase in the bridging market in the next year or so?
It's difficult to say. Apart from involvement behind or backing some of the funder, there's no direct approach, almost none, because it's not an asset class that they like. It's short term. Not always some interest paid, so it's not something that they like. The fact that you have to renew the asset every 6 or 12 months is not easy. So obviously, if you have tensions on the market, they'll have a tendency to withdraw, but they can withdraw for other reasons. It all depends. It's like a global allocation. So if they face problems in other parts of the world, they'll simply reduce asset allocation everywhere. So there's a number of factors that can affect these institutions. For now, it's not the case. There's still like a lot of liquidity, and as we were saying, there's more liquidity right now in the world in family offices than there are in institutions. So family offices coming to lending would more than offset any retreat of the institutional investors.
Interesting.
And just thinking about the lending, when does a family office become a private bank?
Sure.
So if you've got Hawes or Weatherby's, then you become, they're family funded. So, just expanding and doing that.
Well, the banks don't want to do anything anymore, so that's good for us.
More highly governed, right?
Yeah.
And just for a final question for all of you, what do you think will be the biggest challenges and opportunities for the real estate market going forward?
Well, biggest challenge is, I think, restore trust with investors for the UK, which goes with stability of the government and visibility of where the country goes.
Mm-hmm.
There are enough challenges worldwide, economic challenge, not to add political instability right now. So I think one good step would be to know where the country is going and to work on the proper problems rather than working on the political fights and Brexit forever. I think would be a good sign for everyone that market is, that everyone is back to business.
Sure,
and,
less ego and more actual issues.
So after that, the opportunities is difficult to say, but UK is a proper large market in Europe. It's I think it's might be the biggest just before Germany. So there's no reason that it should lag behind the others. If you look at the economic environment, Europe is not that growing. Germany is in recession, or would be if the next quarter shows like a contraction of the GDP. France is at 1%, but we stay there. It's one minus like 0.9, 0.1. There's never growing really. Others are okay, but it's not like it's the party there. So really is really to have the government going back to business and doing what's necessary. Brexit might be an opportunity to do it. I'm not sure that a hard Brexit is the best way to do it, but if we end up after that, it's how you handle the road. It's not only the situation itself. I think it's very difficult. There's not one single area in the world which is kind of growing now. If you look at United States is kind of slowing down. South America is in trouble. Russia is economically is not great. China is showing worse numbers than in history. Basically, since we started to record numbers in China, they're showing the worst numbers. Okay, so
really on the grand scheme
Asia
of things.
is not like growing. So you have political instabilities in other regions, Middle East, Hong Kong and Africa. So commodity environment is difficult. So basically, it's not like relatively UK is like so bad. So it's always a relative issue. If you have investment, you need to have a split of your breakdown of where you want to put your money. Okay, so where and in what. So where it's not like we are doing really bad here. It's not that bad. And in what, equity is highly valued. Bonds are, spreads are historically low, with a very low interest rate environment. So you face a double danger. If risk on the corporate goes up, margin is going to go up, or interest is going to go up. So it's going to eat your value. So after that, what kind of asset class do you want to have? You want to have hard assets, and avoiding the overvalued asset. Of course, you're not going to buy a 2% commercial property, yielding commercial property, but you can still invest in the UK. I think it's the opportunity is still there. You just have to be cautious and take into account the environment.
Sure. Sebastian, opportunity, challenge?
Well, I think political is going to be the challenge. Tax regime, legislation, against property is always getting it's getting trickier to planning, trying to make planning easier. And just, changing use, affordable housing, trying to supply that without discouraging developers. So I think that's so that goes back to political. I think opportunities, as Anna said, London still seems to be the sort of banking centre, financial centre. The position between US and Middle East, where it is, the language, the currency, education, stable. Over the last 3 years, not as much. But it's still relatively stable, and finding opportunities where there's downturn. Equally, the other side, there's a lot of people making money. So opportunities are already being seen.
Okay, Nicholas, what do you think?
We need visibility and stability. Hopefully, we're gonna get that, and then if we don't, we'll try to be opportunistic. That's all I can say. We can talk about Brexit, we don't know if it's going to last. We don't know. We're just trying to position ourselves, especially in terms of asset allocation, looking at those things. And if we can take a short-term horizon doing lending, that's interesting. If we can move to a longer term, buying the asset itself, because it is interesting, then we'll do it also. It's just, trying to diversify and trying to time, regardless of the situation.
Ed?
I agree with everything everyone said. I think no one knows what's going to happen, but if we look historically, to quote LaSalle, because their offices are right behind me, their investment report came out last week, and at the moment they rank London number one real estate investment for growth potential. Now, if we look back historically, London was ranked by them number one in 2008. It fell to number 8 in 2009. It was back to number 1 again in 2010. So, look, I don't know what's going to happen off the back of Brexit, what the outcome will be, but I think if we look at history, and I think that's all we've got to look at, UK's been incredibly resilient, and I've no doubt it will continue to be.
Does anyone in the audience have any burning questions which we haven't already asked so far for any of our lovely panellists?
Just on valuations in the wider residential mortgage market, if we have a hard Brexit, do you see any lenders looking to limit loan to values in certain areas rather than having a blanket lending policy?
I think it's going to be project by project. Again, I would expect them to go down as a whole, but not necessarily not applying like say 5% or 10% on everything. It all depends. And as I was mentioning before, the exit strategy also. Some of them will still be fully in place. Others will need to be revised. So in those cases, you would then need to adjust.
One thing we've seen from banks in the past, they haven't limited loan to values on locations, but they've limited them on capital values. So I'm no doubt that would continue.
Any other questions at all? Oh yeah, we've got one at the back. Chris?
Hi. What does the panel think's in store for the prime and super prime London residential market? From our own experiences, we've seen volumes very much down, but prices seem to have held up quite well. I'd like to get their view on that.
Well, I think we've seen certainly volumes down, but prices have held, and I think that certainly we've seen a bottoming out of the market at the moment, or what our agents are saying. And as more people come in the market, so it's just a cycle, isn't it? People start coming in, and then I must buy that, and someone else has bought there. So it tends to be, especially with nationalities. We're just seeing groups of nationalities buying a certain area, and then suddenly other people buy there, and then it pushes the prices up. So I think, but that's a particular. But I think it's certainly leveled out at the moment, and I think it can only go one way at the moment.
Is that up?
Yes, up. I think.
Just
yeah. No, I think certainly you're seeing, and certainly we're seeing when we're doing valuations, I've done valuations at the moment where it's gone to best bids, so there have been situations like that
Okay.
on certain things. It's not all doom and gloom on it.
One thing on those super prime assets is that if you think about a 50 million, let's say, asset, is it worth 50? Is it worth 40, 60? It's worth what someone's ready to buy. So it's really a question of liquidity and having investors willing to look at it. I think valuation can give us a comfort, but at the end of the day,
It's a preference thing as well, especially in super prime London. It's really a feeling as well for a lot of buyers.
What we know is that for this market, you really have to have the best in your class. Basically, it has to tick all the boxes. Otherwise, you won't attract in liquidity at all. So it's not so much. That's why the prices have kind of fell, because the property that have sold were the ones where you didn't have any problems. Basically, you had all that's required for a super prime property. So being location, amenities or whatever. So basically, or the standards of the works, So the other properties they're not selling. So it's very important to focus on projects which don't have an obvious problem. You're not going to solve the problem lowering your price.
Yeah.
You're just not going to sell at all.
If they were rented out, which obviously a lot of these
Yes,
are, and then possibly sorting that problem out during that period of time and then sold,
Yeah, you could.
But a bad market's always a good excuse for a bad development.
Okay.
But I think certainly the rental market's not a problem that might be in the sales market, might not be perceived by a tenant as a problem. Is they're there for 1 to 2 years. So being next door to someone or motorway or something, or main road, it might not affect them as much on the rental side.
Yeah.
So it tends to be, I think what we were saying earlier about it's very it is very fickle. It's central market. You could be one side of a square or another. Doing a development, someone saying, "Oh, I'm going to do it's super." It might be the right address, but just the wrong side of the road or whatever. It's very fickle. So so it has to tick all the boxes.
Interesting. Any other questions at all before we finish?
Just one in terms of the valuations again and protecting value. Post 2008, we saw a lot of commercial real estate lending go into dynamic LTV covenants. Have you seen much of that in the sort of higher end bridging?
Sorry, just repeat that.
Where you've got a dynamic LTV covenant, so the borrower has to put a bit extra in, or they've got to do something to enhance the value again if the market's moving.
Yeah, actually, sorry to lead that. From on bridge lending, I have seen that a lot more of that. Okay, and a lot more caution as well from their underwriters and loan service management. Okay, so rather than with a bridge loan, typically the lender would contact you, say, a month before you're due to redeem the loan. Now that would be 6 months before, and they'll want an update kind of progress report on a monthly basis, especially with the more risky assets such as land with planning. And we're finding that clients are lenders are really looking for monthly updates of exactly what's going on and how their exit is coming forward.
And is that positive from your perspective with your borrower?
It's positive that the lender is motivating the borrower in that way, because of course you get disorganised borrowers, and keeping the precedent on that, I think, it's got to be a positive thing. Everyone's working in the same direction, right?
Just to add, with the LTVs, you've mentioned should be a little bit more cautious in the bridging market going forward. Are you seeing a rise in second charge bridging because of this? So more lenders coming in?
We see a lot of new second charge. There is risk for everyone. I would just say that. You know, what I know is second charge is you need to be, you need to have the proper analysis.
Okay.
Because, you know, first charge, you're gonna end up, if you don't let crazy numbers, you're gonna end up losing a very small percentage of your loan. Junior, if you're wrong, you're gonna lose everything. So it's you know, it's the opinion of, you know, it's your decision. You know, you want to do a higher return with a lot of risk, or a bit lower return with a very conservative risk. You know? There are investment products or possibilities for everyone.
Just depends, I guess, what the long-term view of being in the market is.
And also, Ed was saying earlier about, you know, equity in the property. So if you've got basically your first loan, and you've got a bridge, you've got a mezzanine as well, you've got no equity. If you've got no equity in the property, then you've got no responsibility. You're saying that, you know, the more you have, the better it is.
Well, the upper end of bridging has always been 70-75%. So let's say if there are lenders, first charge lenders out there now lowering it to 60%, if the second charge is now doing 15%, 10% more, then is it as risky as you think, or?
No, it depends on the project. You know.
Yeah.
It's the same thing. You know, if you know projects have a risk volatility which are not they're not even. You know, it depends on the size of the asset, where it is, what it is. You know, so. You know, if you have a block of flats with you know, units of £500,000, you know, it's less risky to be in a junior position than if you are at 80% in a prime central property, prime central London property, not in a top location. You know? It's really a matter of what is the transaction. You know, I'm not saying that junior lending is wrong or bad. You know, you just have to have a proper strategy. And it's the same for third charge. You know, I wouldn't go to 75-80%. Maybe I'm wrong, but you know, it's you have to get your opinion and form a strategy, and on the back of something. So that's where, you know, data and collecting data and analyzing data is important, especially now. So if you just think you go to junior lending because you get higher return, then I would say you have to be cautious.
Yeah, might not be around for that much longer.
Yeah, and you need to have very good relation with the senior lender.
Yeah, that's also true.
Exactly.
I think to expand on Daniel's point as well, if you've got that 5 flats, you're lending more money, then at least there's probably some breakup value on it. If you've got the same value but a single house, then it's all there.
Yeah.
So it depends on what it is.
Any more questions before we finish the session? Nope. I think we're all good. Thanks so much for attending. It's been great. I think we've got drinks and a bit more networking after this. I'm the editor-in-chief of the Bridging Commercial magazine. It's a free to subscribe magazine, but we've got quite a lot of those scattered around the office here, so feel free to pick up a copy. It's on everything to do with funding, broking, debt advisory, anything in the bridging commercial space, and also quite a bit on development. So feel free to take a copy on your way out. But thanks so much.
Thank you, guys.